bring in our next guest. It's going to be Jenny Horn, markets correspondent, here to help us break it down. Got weekly jobless claims number. Jenny, what do you have for us?
Yeah, 224,000 versus the 215,000 estimate. Prior had been 213,000. So this number is definitely more significant and well above what had been expected. I feel like that's the widest margin, expectation versus the actual number we've seen in quite some time. Continuing claims also came in around 1.87 million versus the 1.9 million versus prior was around 1.91 million. So that figure actually slightly beneath estimates. So a bit of a mixed picture here. I feel like continuing claims has been the figure that's actually come in relatively light versus estimates. Whereas, but again, I don't remember the last time we saw jobless claims beat or outperformance, or at least more jobless claims filed versus estimates as we've seen this time. That 224 is pretty substantial here. Yeah,
historically, Jenny, I'm old, so I've seen historical numbers. Anything under 250,000 is still low numbers at this point. So kind of reflective, and Fed Chair Powell talked about it yesterday. The job market's still doing well and improving, which is what they like to see. But now let's pivot over to some earnings on the retail side. Yesterday, Jenny, we got one popping and one dropping. Let's go with the one that's rallying today, and that's Five Below. This stock was getting hammered this year, down over 50%. It's a really small share float there, but we're seeing some positive moves in the stock, right?
Yeah, I'm frankly shocked by this because yesterday I believe we looked at Dollar Tree and I was talking about the way that these discount retailers, like true discount retailers, dollar store retailers, not your TJX or your Ross stores. These names operate with such razor-thin margins that I think the pricing environment has just become too difficult. I know they've been read as more of that defensive and more staple-esque type retail, but that has obviously not been the case for all these names. Five Below, Dollar Tree, Dollar General this year at least. And other times we've seen economic dips, and it seems like these names have done quite well. That has not been the case. So I guess I was frankly surprised to the upside. They did announce a new CEO. They gave a more solid outlook now for the remainder of this year, and they already have seen solid Black Friday sales, which is huge. So the retailer did say that now they announced that they will see a new chief executive on December 16th. Ken Bull, who's been serving as their interim CEO, which follows the departure of their prior CEO earlier this year, will resume his role as chief operating officer. Winnie Park, who did serve as CEO of Forever 21 since 2022, will be taking over at the helm. Now, the leadership change and aimed forecast does really arrive at a good time, especially because over the summer, this company did say it was ratcheting back its expansion plans as its lower income shoppers struggled with the cost of living and compensation overall was a concern. So now I think this is hugely encouraging that taking a bit of a pause on their growth plans has allowed them to actually guide for more than what the street had been expecting. We did see that roughly a 3% dip in same-store sales was a weak spot. The forecast, though, was better than what they gave back in August, so that was considerable. They did also say they expect now adjusted earnings per share to range between $4.78 to $4.96 versus the prior forecast, which had called for top of the range at around $4.71 versus, well above what they had previously guided for. They also did say now revenue rose about 14.5%, and they guided for more strength into the fourth quarter here. So I think all of this is encouraging, especially when you look at the retail environment. It's been difficult. We've seen these very clear winners and losers, and it seemingly, based on today's move, at least this morning's move, is falling into the better than feared camp, because I would not say this is operating from a point of strength, but at least maybe starting to make a recovery here.
Yeah, I think a sigh of relief. And then there was a big short open interest position in that stock also with that small float. Anything that was better than expected. I'm not surprised we're seeing a pop there in Five Below, but watch out ahead. You mentioned Dollar Tree, Dollar General that reported this morning, and Five Below. They're going to be impacted by tariffs first and foremost, as you mentioned, those razor-thin margins. But on the flip side, we've got some weakness in another retailer, and that's American Eagle, right?
Yeah, not as thin of margins here. As I will say, American Eagle to me falls more in the pricing range of like an Abercrombie and Fitch, maybe around an Urban Outfitters. And those names have seen really nice earnings. So this is now, I think, becoming more of an American Eagle story, frankly, not just a mall discount retailer or maybe teen retailers where they target. But I would say that this is an American Eagle specific story. We saw shares fall this morning after their third quarter results did pretty substantially miss estimates. They did see their fourth quarter outlook also come in short of expectations, and their CEO said the company is entering the holiday shopping season well positioned, but did note that sales could struggle in the non-holiday shopping periods of their fourth quarter. So that's also not what you want when you basically can say that discount promotions are what's driving in consumers, and we're not going to see that great of foot traffic outside of that. I mean, what are you really guiding for here? I think that that's not encouraging at all. They did record a near $13 million on restructuring charges on the severance costs and the pending sale of their business in Hong Kong, as the company does shift to a franchise-heavy model in that region. But after adjusting for that change, their adjusted net income came in around $93 million. That was actually above the $91 million expected. Well, we had expected around comps to come in around 3.2%. Their 3% growth also came slightly under. And they did say, looking ahead, they expect comp sales to be in line with expectations at around 1%, while the projected 4% decline in revenue was actually greater than had been expected. So they're expecting more weakness in sales. Definitely, at least I think encouraging that comps are at least positive. I mean, I can't tell you how many retailers we've talked about that are negative and guiding for more negative comp growth for the remainder of this year into next. But again, a miss is a miss. And shares were down as much as 13% I saw this morning. So obviously, when you're not able to meet even your own bar that had been, I think, relatively reduced after their last earnings call, you're going to see some pressure here again. This was actually very similar to the move we saw last quarter when we saw a bit of a reset in terms of its price.
Yeah, offsetting from maybe ANF, which is up over 80% this year. So a little maybe bifurcation there. And I know they did get downgraded by JP Morgan also this morning at AEO. All right, great stuff. Thanks to Jenny Horn, markets correspondent here, breaking down a couple news stories.